Did you know that the IRS is cracking down on cryptocurrency? And this is exposing cryptocurrency investors and Web3 businesses that aren't compliant to risk of penalties, interest, audits, and in some cases, even more severe consequences that we'll be discussing here today on this video. According to the IRS, 75% of people and businesses transacting in crypto are not compliant, meaning that they're not accurately filing their taxes on a yearly basis. Now, if you're watching this video, I encourage you to comment below with your biggest tax question or challenge that may be preventing you from filing your taxes. And if you're unsure about your tax obligations, contact me and my team at camusacpa.com. So let's get into what you should do if you haven't filed your cryptocurrency taxes. Now, at Camusa CPA, I'm working with people on a daily basis that haven't completed their cryptocurrency accounting and haven't done their taxes for several years. Just last week, we had to go back and do someone's accounting starting from 2014 and do it each year going forward. So, this is a very common thing that we're dealing with. And if you're in this position where you haven't done your accounting for years, you haven't done your taxes for years, you're not alone. But, since the IRS classifies cryptocurrency as property, there is a huge undertaking that you're going to have to go through to get your accounting and to get your taxes in order. So really, what are the first steps? It's going to be compiling all of your transactions for the accounting process. And now if you are someone that hasn't done your accounting for years, there's a cumulative nature to tracking your cost basis year over year, meaning that if you purchased Ethereum or Bitcoin or Solana several years ago and you've been transacting in that, maybe buying altcoins, buying more of whatever the main currency is, going in and out of all these trades year over year, there's going to be cumulative cost basis that accrues over multiple tax years, meaning you may have purchased some Ethereum over several months in 2020, then more in 2021, and more in 2022. So that is the first thing to understand, that if we're going to accurately calculate the cost basis that you have in the current year, we're going to need to start with when you first started trading and calculate it each year going forward. Why? Because if for instance, we're going to do a calculation for 2025, our starting point is the ending point of 2024. So each year really builds upon the next year. And that's also why, when I'm working with someone at Camusa CPA, like, two of the biggest things that we run into is, number one, if they haven't done their accounting for years, obviously we have to go back and rebuild it. Another issue is that a lot of times the accounting's been done either by, self-managed or by another CPA firm, and it's just been done improperly with lack of due diligence. Specifically, once you have your calculated ending holdings, not comparing them to your on-chain holdings. And if there's any discrepancies there, that's going to carry into future years. So a lot of times we'll even work with people who, they've attempted their accounting, they've attempted their tax reporting, but it's inaccurate, it's incorrect. And because it carries into future years, we're still going to have to redo it. So really, you need to go back and you need to get all of your transactions, and you're going to need to deal with any data gaps that are in there. And that may be outside of the scope of this video, but you're going to have to get every exchange, every wallet, and compile every transaction. So you can imagine that, when we're working on these engagements going back several years, a lot of times there's going to be missing data from defunct exchanges or for other reasons as well. And that can lead to less favorable tax outcomes for you as the taxpayer. So that is another reason why you want to do this and get this done as soon as possible. Another thing to keep in mind in terms of the tax enforcement landscape is that exchanges are going to start reporting this information to the IRS at a much higher rate in a much more standardized format than we've seen in the past. And that is because starting this year, we're going to have what's called the 1099-DA, which is the 1099 digital asset tax form, where there's going to be third-party reported data going to the IRS from exchanges and from other places where you may be transacting. So, if you think you could fly under the radar and just take another year of not doing the accounting and not reporting the transactions because maybe the IRS doesn't know about it, that's not a good approach, and it's going to increasingly lead to more tax controversy, more tax notices. And we've already been seeing a lot of that at Camuso CPA in the past because the IRS already has a lot of this data. But now that we're going to have the standard tax form start going out this year and in future years, I'm anticipating even a larger rate of that. So, tacking onto the 1099-DA, another thing that taxpayers have to keep in mind is that we had Revenue Procedure 2024-28 that came out last year. I've done whole separate videos on that. But that requires everyone that's been doing their accounting on a universal basis, and most taxpayers have done their accounting on a universal basis in the past. They have to switch to an account basis starting in 2025. And again, I've done separate videos on that as well. But this can be another issue that if you do your accounting inaccurately and you report your taxes wrong, you may start to get tax notices just because you're not doing your accounting on the right methodology. So, it's extremely important that you report all of your cryptocurrency transactions. This is going to not just give you peace of mind when you're dealing with the IRS, but it's going to protect you from interest and penalties. And what I find with a lot of clients is once we go through this process, and it can be a painful process of getting you up to date after years and years and years, once we're to that point, we have a clean cost basis calculation. Many times it puts you in the driver's seat from a tax perspective, and it gives you tax planning opportunities once you're able to review exactly where you stand in a given year regarding your capital gains exposure and what your cost basis is, given where the market is at. There may be loss harvesting opportunities, or there may be more advanced tax planning opportunities if you start thinking ahead and be more proactive with your taxes rather than basically just trying to hide under a rock and not pay them. That's not the right strategy when you're transacting on a public immutable ledger. So you're going to get this peace of mind when you file, but you're also going to get the potential to optimize your taxes going forward. Now, there's heavy consequences for people that don't report their taxes. There's significant accuracy related penalties up to 20%. If there's intentional non-compliance, there's fraud penalties that can be up to 75%. And as we've most recently seen with the first pure tax indictment case from the Justice Department with Richard Algren III, there can be criminal charges. In the example of Richard Algren III, he's going to be looking at 3 years in jail based off of the plea deal that he said with the Justice Department. And he also has to turn over his private keys to the IRS for the crypto assets that he's accumulated that is being reported as over $120 million in value. So, there's heavy consequences to not reporting, and you don't want to fall into this trap of not reporting and, become one of these examples like Richard Algren III, because what I'm predicting is that as we move forward, we're going to see a lot of other cases like him. And likely, that'll slowly bring more awareness into this space and we'll start to see a higher degree of compliance. But you don't want to keep waiting to see longer. I suggest, getting into compliance now before these tax forms start coming out, before we start seeing more tax enforcement. You don't want to be like one of the many people that get a tax notice from the IRS that is saying, hey, we know that you have trades that you're not reporting. You need to report it and respond within this time frame. You don't want to get put in those scenarios, because then we have to go and we have to do these long, arduous, complex calculations under very quick time frames with these tax notices pending. And there's a lot of challenges when it comes to tracking and reporting cryptocurrency transactions. You're most likely dealing with multiple exchanges, multiple wallets, and if you haven't reported for yours, we're going to have to go across many tax years. And what can happen there are obviously data issues, data gaps if we're dealing with defunct exchanges, and it's going to require a very meticulous, methodical categorization and reconciliation process and a strong due diligence process. And this isn't something where you're just going to take your wallets, pop it into a tax software, and then send off your reports to the IRS. It's going to be much more involved with that. It's going to take much more of a detailed effort and undertaking to get your cryptocurrency accounting accurate. So what are the steps that you need to take if you haven't reported? Number one, it's compiling all of your transactions across centralized exchanges and across all of your wallets and accounts. Then you need to do your cryptocurrency accounting for every year, and you need to do it accurately with the proper due diligence like we've discussed here and I've discussed on other videos. Then from there, you need to work on amending any tax returns that you have filed inaccurately in the past and filing any delinquent returns that you neglected to file in the past. And then from there, of course, you're going to have to pay your tax liabilities and deal with any associated interest or penalties that arise from that. So, this can be a very difficult process and a stressful process as well. And if you do have a complex portfolio with a lot of moving pieces, the accounting complexity can quickly become overwhelming for the average taxpayer, founder, or business owner. And that's when a firm like Camuso CPA can really add value and assist you with these tax and accounting needs, because we're helping people every single day get their crypto portfolios up to date, get their tax filings up to date, and actually get into compliance and resolving these tax issues with the IRS. So, to summarize, it is extremely important to get out ahead of this issue. We're going to have a, very big year when it comes to IRS tax enforcement related to cryptocurrency, and you do not want to get ensnared in that. So if you are like the many people out there that have neglected your cryptocurrency accounting and have not filed your taxes, now is the time to contact me and my team at Camuso CPA. We've helped hundreds and cumulatively thousands of people with this issue, and we can help you with this issue as well. We can get your accounting up to date, we can get your taxes filed, and we can help you resolve any issues with the IRS. So if you need assistance with this, contact me and my team at CamusoCPA.com, and I'd be more than happy to assist you. Until next time, I'm Patrick Camuso, signing off.